Hi everybody, this is Nicole Vanderstorm and I am back to take my TCC Accounting 2301 students through Chapter 6. Now folks, as a reminder, this is not intended to replace the detailed presentation lectures that I've uploaded to your modules, and it is not designed to replace your own studying time and your own review of both the textbook as well as the presentations, as well as the recordings that have been specially recorded for you by Professor Jay Simpson. All right, folks, let's just quickly have a look at Chapter 6. Now, when we last left off, we had discussed merchandising operations, and we were looking at the last journal entry of the cycle, which was the credit to merchandise inventory, and then the debit to cost of sales. Now, remember, we do not have a GL account called gross profit. So we're having to recognize merchandise inventory sales in two journal entry steps. The second one I've just mentioned to you. And the first one is your debit to your bank or your accounts receivable and your credits to sales. And remember, your second journal entry will be your debit to cost of sales and your credit to merchandise inventory, because what you're doing is you're removing stock out of or inventory out of the merchandising inventory GL ledger, and you're putting it in the cost of sales line item on the income statement. Okay, folks, and the reason why we're doing this is because of the accrual principles of US GAAP accounting, and that is that we match our revenue to our expenses. So in this example, we're immediately matching our revenue, being the sales and the units sold, to the expense being the cost of sales based on those very same units sold. All right, folks, so I'm just going to walk you through a very summarized approach, which really summarizes the four, or should I say the three different ways to account for inventory. So let me share my screen with you. All right, folks, so I've put together the spreadsheet, and I did test it earlier on a live class, so let's get going. All right, so let's have a look here. We're talking about three types of inventory recognition. Now, the critical issue is that, we're dealing with a whole lot of homogeneous, similar products that are coming off a production line. All right, so we're talking about really high quantities that we cannot account for on a one-by-one basis, all right? So these are the three types of inventory valuation methods, but the fourth one is what we would call item-by-item valuation or item-by-item costing, which is where you can measure or where you can define the cost of sales or the inventory costs or the inventory balance sheet values in respect of specific units. Now we're talking about custom vehicles, we're talking about custom handbags, we're talking about a small business that only maybe sells 10 or 12 items a day or a month, okay? And normally these guys would be running on the periodic inventory system. Now, the periodic inventory system is what you've learned in chapters 1 to 4. And if you think about it, the only type of inventory or current asset that a service enterprise has is office supplies. And just reminding you guys that what we did was we would debit office supplies and credit cash to be able to put it on the balance sheet. Then at the end of the financial year, we calculated what the closing balance was. We determined the difference, and then we passed an adjusting journal entry to credit office supplies, the asset, and debit the expense item on the income statement called office supplies expenses. All right, folks? So now we're going one step further, okay? Now, we cannot specifically do a massive stock count every single month, right? For every single accounting period, because the quantities are just too much. So what folks use is what we call a perpetual inventory system. And all that means is that your inventory values are recalculated straight after every transaction. And this is normally done by computed. It's normally automated and computerized. And what you would find is that you would likely have an annual stock take, which the auditors would attend. And the goal of the stock take is to make sure that your closing balance on your inventory system agrees with the closing balance on the floor in the actual storeroom itself. And then your difference would be an expense to shrinkage because, well, it's not there anymore, right? Sometimes some listed companies or some publicly traded companies would do the stock counts on a quarterly basis, but not necessarily have the auditors attend to actually check the stock count, but they may attend to audit the internal controls in the stock counting process. Now, what would those kind of internal controls be? Well, you'd probably have two people counting, the first guys, and then this first round and the second round, to make sure that no big gaps have been missed. Also, you would have folks writing down on a piece of paper that someone will punch in and someone will check that. Those are some of the controls. Another control is that you would be labeling each and every section and being sure that only those sections are counted by certain people and that they're tied back to your cost or your counting sheets that you issue to folks. So there are a lot of controls even in the stock counting process. So just remember, folks, as we work through all of these items, keep in the back of your mind, what would the internal controls be applicable here? All right, so let's have a look at this example. So the best way to describe this example is to just jump right in. So let's say on February the 28th, no, let's do this. Let's say on December the 31st, okay, our opening stock is 100 units at $5 a unit. So we're going to say it's $500. Okay. Weighted average, we'll have the exact same opening balances for everybody. Okay, just for theory. All right. Let's say that on January the 15th, we buy, so we're going to say purchase of 200 units at $7 a unit. Okay. 200 units at $7 a unit. And your total for that is going to be D4 times C4. And I may as well just copy this equation right across. All right, folks. So now we know that after this purchase, we have 300 units. And the value is, for all of them, after this purchasing transaction, is $1,900. Right? So we all know this because they're all having the exact same transaction. Now, the issue of the way to value your stock is not in the buying side of things, okay? The issue arises in the actual selling side of things, because the question is going to be how much or what was the cost of sales of the stock that or of the inventory that I just sold. So let's do another example here. So folks, we know that we have 300 items of inventory that is valued at $1,900. Okay, so the first thing that we're going to do, we're going to look at weighted average cost. Okay, and the best time to actually weight your average cost is after every single purchase transaction. So here we have 1,900 units. Sorry, 300 units at a cost of $1,900. So your weighted average cost per unit is going to be this. It's going to be this total dollar value of the stock divided by your total units. All right. And of course, I'm going to have to times this by 100. Oh, no, I'm not. Okay, so we know that the cost per unit per the weighted average method is $6.33. Okay, so that's your first step. Calculate your weighted average cost. Okay, then your second step, or for purposes of my example, let's say that we sell 200 units on January the 30th. We sold 200 units. Okay. Now, we are never, ever interested in the sales price, okay? Remember, folks, if you put down a sales price, you are making a mistake. Sales price of goods has nothing to do with cost of sales. So remember, all we're interested in is the quantities. We don't care about the sales values in respect of the cost per unit or in respect of the sales price per unit, okay? What we want to figure out is what the cost per unit is that we're going to carry the sold items at, okay? So here we are, we're selling 200 units. All right, folks. So the first thing we're going to know is I'm going to put a minus in front of each of these to represent that our stock is, or our inventory is shrinking. Okay, so let's just do this. I'm going to say minus 200. I'm just going to copy and paste that across to my different cells. Okay, so now I have 200 units that I have sold. Okay, my assumption is that with FIFO, it's first in, first out. Okay, so my question is, what will my cost be of the units that I have sold? So I've got 200 units, first in, first out. So I'm interested in these transactions. So I'm going to say that I sold 100 units that were valued or that had a cost value of $5. So it's going to be 100 at $5. I'm going to minus that at $5. So let me just bold this so it just makes it a little bit easy for you guys to see. Okay, so 100 at $5 gives me minus 500, right? So I'm just going to put a minus in front here. Let's just put the math, the same math here. Okay, so we know that the first $500 worth, in other words, the first 100 units were sold first, followed by the next 100 that makes up this 200. Okay, and that's going to be minus 100 at $7. Okay, and that means that your closing balance is going to be 100 units of stock or 100 units of inventory, which is what we all know here, at a value of $7. Okay. So we know that. All right. So when you're working out the closing inventory, always use the last quantity. Okay. So there's a shortcut, but it's a backward shortcut. I'll show you in a second. Okay. When it comes to LIFO, what we say is that the assumption is that the last items in are the first items to be sold. So we're talking about this piece over here. So what we're saying is that the 200 units that we sold is this 200 units. The last 200 or the last 100 is part of this tranche of the last 200 units that we bought. Okay, so it's just going to be 200 units. Okay, so it's just going to be 200 units at $7. In other words, it's going to be 1,400 that we've sold. Okay, and then our closing balance is going to be 100 units at $5, gives us $500. Okay. Now, folks, I want you to have a look at something here. Now, I'd like you to notice a few trends that are really important for you to understand how inventory actually affects our books. So I'm just going to choose a different color. I think I will go for red because I want to be sure that this is very clear. All right. Which one has the highest closing inventory? FIFO. Okay, so I'm going to say FIFO has the highest closing inventory. all right, is FIFO. Well, let's do this a little differently, just to make it simple. So FIFO has the highest closing inventory. So I'm just going to say highest closing inventory, okay? Then LIFO, as you can see, has the lowest closing inventory. See that? Okay. But also, if you have a look here at your weighted average cost, it's going to be 100 units at $6.33 per unit, right? So your closing inventory here is going to be 100 times 6.33. $633, okay? And what you will notice is that the weighted average, or the weighted average amount, the closing stock amount is always in the middle. See that? It's always between the cost of LIFO, or the closing balance of LIFO and FIFO. See that right in the middle? Okay, so folks, there's a quick way to do all this when you're trying to figure out your cost of sales. All you have to do is calculate your closing stock and deduct it from your balance. Very simple. Okay, folks? So all you would do is calculate your closing costs, deduct it from the closing of your previous transaction, and then that's how you would know what your actual cost of sales was for the items that you sold. Okay? So let's just go back. So the highest closing inventory is by FIFO, and the lowest closing inventory is by LIFO. Now, obviously, the condition here is that we're talking about increasing prices, right? Because it went from $5 to $7 per unit. Okay, folks. Now, when your closing inventory is higher, that means that your cost of sales is going to be lower. Therefore, your profits are going to be higher. So I'm just going to say net income, NI. Therefore, you're paying more taxes. And of course, it's going to be the opposite for LIFO. So let's think about this. In international accounting standards, or IFRS, International Financial Reporting Standards, basically what happens here is that you are not allowed to use LIFO. Okay, and the reason being that if you look at it, it looks like what you're doing with LIFO is that you're understating your profits. Okay, so it's your less inventory, therefore less profits, therefore less tax. Okay, so you're understating your profits, so that, and therefore your taxes are going to be a bit lower. So it's not allowed under IFRS. Here in America, it's allowed, but it's allowed basically for the oil industry. Now, if you think about it, way back in 1973, there were the oil price shocks with the formation of OPEC. And what had happened is that the value of the oil had skyrocketed so much that if the folks recognized their cost of sales on a FIFO basis, their cost of sales would have been so little and their profit would have been so high that they would have had to pay enough taxes to actually put them out of business. So this is why the government has allowed them to continue with their LIFO accounting. Because if they were to recognize their oil reserves dating, or their oil purchases, or their oil stocks dating to before the 1973 crisis, their closing balance would be much higher and they'd be getting hit with a much higher tax, which the industry lobbies and says that they cannot afford. Okay, folks, so what's really important to know is that most companies use FIFO, some companies use weighted average, and probably only the oil and gas industry uses LIFO. What I will do is I will Google some information for you and I will post that as well for chapter 6 so that you get a little bit of a background on what happened with the oil industry and the price and the oil price shocks and oil supply shocks in 1973. All right, folks, and then the last point that I wanted to make in respect of chapter 6. Chapter 6 comes back and it talks to the qualities of a set of financial statements that would actually reflect that the financials are a fair representation of both the financial performance, income statement, and the financial position and balance sheet of the business. So I just wanted to quickly go through those items with you. And to do so, I'm just going to give you a little whiteboard. Folks, I just want you to bear in mind that we do have 4 principles of accounting, okay? 4 principles. So these 4 principles help us classify and report items on the financial statement. Now, I'm not talking about the assumptions, okay? Remember, the assumptions was going concern, that there's no change to the currency, that you're using your historical cost as well as your economic concept, if you recall from chapter 1, I think, or the first lecture. Okay, but the 4 principles help us classify. And the first one is consistency. In other words, we want to be able to, sorry, I'm just going to write it like this, consistency. We want to be able to compare year over year. So that means that your financial reporting needs to be done on a consistent basis. So what you do this year is what you're going to do next year, is what you're going to do the year after. Okay, so you're not going to change your approach to the way that you, for example, value your stock, okay, or value your inventory. I'm sorry, I keep using my South African word. Okay, the next principle is one of disclosure. In other words, it's about making sure that you're actually providing enough useful information that will provide the users of financial statements with enough information to make decisions. So we're talking about relevant information for disclosure purposes. And again, who are our 2 main external users? Our creditors as well as our investors. Right, the next one is materiality. Okay, now when we talk about a set of financials being a fair and representative disclosure in respect of the performance and the position of the business, right? We look for any errors that would cause a user to make a different financial decision. Those are material errors. Okay, Enron committed major material errors, right? And the one that we really looked at was the material error of Blockbuster, where they recognized the revenue from the expected revenue from the wholesale or the whole purchase of Blockbusters, rather than actually accruing it over the relevant years and recognizing it as the revenue is earned, okay? So what they did was they overstated their profits by hundreds of millions, and that was a material error because the investors actually made decisions to invest in Enron based on that error. Now imagine if they'd been honest about it, their net profits would have been much lower and therefore probably less attractive to investors. Okay, and then the next point is accounting conservatism. All right, now what's really important here, folks, is that you really have a non-biased view when it comes to determining, for example, from a fixed asset perspective, when it comes to determining the useful life of the asset, you would want to be conservative and assume that it's going to last shorter rather than longer. The same thing with inventory. Folks, what you're going to recognize is that you have to choose the lower of the cost or the net realizable value. So back to my example where we were talking about buying technology items and then 2 years later still having them in our stores. I think it was the iPod example. And what we realized is that there was no ways we could ever recover our money that we spent buying the stuff or the cost of sales amount. So we had to write it down and recognize a much lower cost of sales. So just bear in mind that you're not necessarily overstating in your favor, but you're also being realistic. Okay, so you don't want to swing both. You don't want to swing strongly either for being favorable in your assumptions or being unfavorable. Folks, the issue here is that you need to be unbiased and you need to trust your gut and act with ethics. Okay, so you need to do what you know is right and you will know. Okay, when we talk about consistency, there was just one point that I wanted to make. Okay, sometimes, excuse me, sometimes what happens is people can change, or companies can actually change their approach to financial accounting, right? Or their approach to, oh, I apologize, let me share the screen again. Folks can actually change their approach from weighted average to FIFO, for example. Now, what you will see when you actually change your approach is that the actual value of your closing stock would have been different last year compared to what it is this year. All you need to do is you don't need to go back and do a restatement because it's not considered a material error. All that you're doing is you're changing your accounting approach from FIFO to weighted average, for example. Okay, so all you need to do is make the adjustments to ensure that in your current year that you're using the correct closing balance, and you just put a note in explaining why you changed, or explaining that you changed your inventory valuation method. Probably the most popular reason is because of the requirements by the Internal Revenue Services, because if you recall that accounting for tax purposes is really based on cash flow and what inflows and outflows you have. So they would also, in some cases, require that certain industries follow certain stock valuation processes for tax purposes. Okay, so that's probably one of the main reasons why folks would actually change their evaluation approach. Okay, then also one other example, I think I did give you this in the past, but you would have learned this in chapters 1 to 4, but depreciation. Let's say that going forward, you suddenly find, well, an item that you assumed was going to last 5 years is now going to last 7 years. You don't have to go back and restate all your accumulated depreciation. All you're going to do is just balance up the amounts that you recognize in the current year so that your accumulated depreciation is the correct total. And then you would just, actually, no, what you would just do is you would just calculate the difference between the years, and then you would just adjust accordingly. So let's say you had an asset that you thought was going to last 5 years, suddenly it's only going to last 3, and you're on year 1, well, then you're only going to depreciate for another 2 years. So therefore, you're going to just 50-50 it, and you're just going to put a note in your accounting policy that informs users that you actually have changed your expectancy of that particular class of assets. So that's one more item, you know, where it's not considered a material error, where you are changing your assumptions, right? And assumptions and the value of inventory and the assumption of the useful life of the asset is often based on management assessments, and things change, right? And managers learn more and understand more. And so, you know, there's a lot of human influence, a lot of estimates, a lot of best guesses. And this is why we can never, ever have 100% accurate financial statements. That is why auditors are only required to attest that the financial statements fairly and reasonably represent the financial state of the business. And that means that it reasonably represents the financial performance as well as the financial position of the business. All right, folks, so that's what I wanted to go through with chapter 6. We have a really good example that's up in your modules. It's an individual assignment, and I have given you the solution at the outset because I would like you to practice the methodology of working through it. But remember the shortcut. All you're going to do is calculate your closing stock, and then the difference between your closing stock and your opening stock is going to be your cost of sales. That's the shortcut way to do it. All right, folks. Well, I hope that you have a great day. Thanks for attending my lecture, and I will see you soon. Take care.